Today, we're breaking down DBP, the Invesco DB Precious Metals Fund, one of the earliest and most established precious metals ETFs on the market. DBP is not a mining stock ETF, and it does not hold physical gold or silver in a vault. Instead, it provides exposure to gold and silver through futures contracts, using a rules-based strategy designed to reduce one of the biggest long-term drags in commodity investing. Contango. DBP tracks an index composed of gold and silver futures contracts, with more than 80% of the portfolio typically allocated to gold and the remainder to silver. The fund intentionally excludes platinum and palladium, keeping the exposure focused on the two most liquid and widely traded precious metals. As a result, DBP behaves more like a core precious metals allocation rather than a broad metals basket. What really differentiates DBP from many other commodity ETFs is how it selects its futures contracts. Most futures-based ETFs simply hold the front-month contract and roll it every month. That approach can significantly hurt performance when markets are in contango, where longer-dated contracts cost more than near-dated ones. DBP takes a more sophisticated approach by selecting contracts based on the shape of the futures curve, choosing the contracts with the highest implied roll yield. In simple terms, the fund attempts to minimize roll costs and, when possible, benefit from backwardation. This does not eliminate futures-related friction entirely, but over long periods, it can lead to materially better results compared to a basic front-month strategy. It's also important to understand how DBP differs from physically backed ETFs like gold or silver trusts. Because DBP uses futures, its performance can diverge from spot metal prices, especially over longer holding periods. Returns are influenced not only by movements in gold and silver prices, but also by roll yield and futures market structure. This added complexity is the trade-off for potentially improved long-term efficiency compared to simpler futures approaches. From a tax standpoint, DBP is structured as a commodity pool, meaning investors should expect to receive a K-1 at tax time. Gains are taxed under the 60-40 rule, with 60% treated as long-term capital gains and 40% as short-term, even if shares were not sold. Because of this, DBP is generally better suited for tax-advantaged accounts rather than taxable portfolios. DBP is rebalanced and reconstituted annually in November, maintaining its gold-heavy allocation and futures optimization rules. This makes it a strategic exposure rather than a trading tool. It can serve as a hedge against inflation, currency debasement, or geopolitical stress, but it is not designed to perfectly track spot metal prices day to day. Bottom line, DBP is best viewed as a long-term precious metals allocation for investors who understand futures mechanics and want a more thoughtful approach to managing contango. If you're looking for pure physical exposure, this may not be the right tool. But if you want gold and silver exposure with an intelligent roll strategy baked in, DBP stands out as one of the more refined options in the precious metals ETF space. If this breakdown helped, hit like, subscribe to the ETF Investor, and let me know in the comments whether you prefer physical metal ETFs or futures-based strategies for precious metals.